Welcome back to the deep dive. Our mission today, well, we're going straight into the human brain.
Not just any brain, though.
No, specifically the brain of someone who's owned a high-value asset for a long, long time. Maybe 30, 40 years.
Like a mobile home park owner, an MHP owner.
Exactly. We're really focusing on the behavioral psychology of the exit, that critical moment when they're ready to sell potentially their biggest asset.
It's such a high-stakes moment. And our sources really highlight this huge communication gap.
Yeah.
You've got this veteran owner, right? Someone who's seen recessions, fixed countless leaky roofs.
Knows the business inside out.
Totally. And suddenly their phone's ringing off the hook. Slick buyers offering all cash.
Right, all cash.
Yeah.
And that phrase, it sounds so simple, so easy, doesn't it? But for these veteran owners, it often triggers this immediate, almost gut reaction.
Distrust.
Exactly. They've spent decades mastering complexity, dealing with tenants, regulations, repairs. Simplicity feels suspicious, especially when someone promises it'll solve everything instantly.
And that's the core paradox we really need to unpack today.
Yeah.
We're looking at the mental shift, the psychology needed to get past what experts call the status quo bias.
The bias towards sticking with what seems easiest or most familiar, like cash.
Precisely. Our goal is to uncover the psychological levers that can make seller carry, owner financing, not just another option, but actually the strategically smarter and frankly more emotionally satisfying choice for a sophisticated seller.
So it's about reframing the whole conversation, moving the seller beyond thinking of it as just selling an asset.
Yeah, it's more like a graduation.
A graduation, how so?
From being the hands-on landlord to becoming the bank. It's a different role, a different kind of control.
Okay, I like that. So this deep dive, it's really about showing why the option that seems safest, all that cash right now, might actually feel like a loss down the road, and why the truly smart move often involves maintaining control.
Control over the tax hit, control over their future income, and yeah, control over the legacy they've built. That's really what we're digging into.
All right, let's jump right in then, because the first big psychological hurdle, it isn't really about greed, is it? It's more fundamental.
It's fear, pure and simple. It's the principle of loss aversion. We know from, well, decades of research that humans hate losing something way more intensely than they enjoy gaining something of equal value.
Okay, loss aversion. So the status quo bias cash equals safety is incredibly strong here. How do you even start to challenge that?
You have to flip the script completely. The successful approach doesn't focus on the shiny object, the pile of cash. No, it focuses relentlessly on preventing future regret.
So you ask the seller, what do you actually lose if you take all this cash right now?
Exactly. What's the downside? The most obvious thing is probably the future interest income, right? They could be walking away from potentially hundreds of thousands over the next 10 years by not holding that note.
Okay, that's the long-term opportunity cost. But what about immediate pain? What do the sources say about that?
The immediate and honestly often devastating loss is the tax liability. It's huge.
Ah, the tax man cometh.
Right. When you sell a highly appreciated asset like a park that you've owned for decades, and you take a massive lump sum in cash, boom, you're instantly hit with a potentially enormous capital gains tax bill. We're talking maybe 20, even 30%, due almost immediately after closing.
So the framing shifts. It's not you'll make more interest later with seller financing. It's more like
It's you stand to lose a six-figure sum to the IRS tomorrow if you take all this cash today. That's loss prevention. That gets attention.
and seller carry offers a way around that immediate hit.
Absolutely. It allows the seller to use the installment sale method for tax purposes. This is crucial. They avoid that massive upfront capital gain spike. Instead, the income and the tax on it is spread out year over year only as they actually receive the payments.
So deferred income taxed much more gently over time.
Exactly. Much more manageable.
Wait a second, though. I mean, the obvious pushback here is risk, right? Cash is cash. It's in the bank. With seller carry, what if the buyer defaults? Isn't that a huge headache? Litigation, uncertainty.
That's probably the #1 objection, and you absolutely have to address it head on. But here's where the expert perspective really reframes things again. Cash itself starts to look like the risky move.
How so? Cash seems like the definition of not risky.
Well, it sounds simple, but then the seller starts thinking, okay, I have, say, $1 million cash, now what? Suddenly, they realize they have this huge sum to manage, to protect, maybe needing to invest it in a volatile stock market they don't fully understand.
Plus, they're dealing with that big tax bill we just talked about.
Exactly. So the cash, which seems simple, now looks stressful, precarious even. They've just traded an asset they knew intimately, the park, for a pile of money they now have to babysit, as one source put it, plus a major tax liability.
The fear shifts. It's less about the buyer defaulting
Which we'll get to why that's actually quite protected.
and more about the fear of mismanaging this big chunk of cash or losing it in the market or just the stress of dealing with it all.
Right. And suddenly, seller carry, with its steady, predictable monthly checks and those deferred taxes, starts to look, well, responsible, calm, financially mature even.
That's a powerful reframe. Okay, so once we've addressed loss aversion and reframed the risk of cash, what's next? The outline mentioned identity and pride.
Yes, this is where it gets really interesting psychologically.
Yeah.
You have to appeal to who the seller is. Remember, these aren't flippers or rookie investors.
Yeah.
These are veterans. They've poured years, decades sometimes, of their life, their sweat, their soul into these properties.
Right. The sunk costs aren't just financial, they're deeply emotional.
Exactly. And a quick, impersonal cash sale can sometimes feel, well, almost disrespectful to all that effort, like throwing away years of painstaking work. It might be an easy exit, but maybe not a proud one.
So how does owner financing tap into that pride, that identity?
You present seller carry not just as a financial tool, but as a kind of badge of mastery.
A badge of mastery. Tell me more.
The seller isn't just cashing out. They're graduating. They're elevating their role. They move from being the landlord, the person fixing the leaky roof, dealing with tenant calls.
The day-to-day grind.
Right. They graduate to being the bank. They're the one setting the terms, holding the note, retaining financial control. It demonstrates a level of business savvy that, frankly, the simple all-cash buyers don't offer an opportunity to express.
So they trade the operational headaches for the dignity of financial oversight. That feels like it directly rewards that deep emotional investment, the sunk costs you mentioned.
Absolutely. Seller carry can be framed as the mechanism that rewards those years of effort. It ensures that the park, this thing they built, keeps paying them even after they've stepped away from the daily operations.
It's like dividends on their sweat equity.
Precisely. They're not just getting paid for the land and the buildings. They're continuing to earn from their personal commitment, their history with the property. It changes the whole narrative. It's not an ending. It's a continuation of their success story, just in a different form.
Okay, so we've appealed to avoiding loss. We've appealed to their pride and identity. But financing can still sound complicated. How do we make this sophisticated choice feel simple? Let's talk cognitive ease.
Yeah, this is crucial because even if the logic is sound, if it feels complicated or unfamiliar, people resist. We have to achieve what psychologists call cognitive ease.
Meaning it has to feel effortless to understand?
Exactly. Drop the jargon. Forget amortization schedules and complex collateral clauses in the initial conversation. The core message needs to be incredibly simple and relatable.
So what's the elevator pitch? How do you simplify the monthly payments concept?
The message is all about freedom and predictability. It boils down to you get a check in the mail every single month. No roofs to fix, no rent calls to answer, no tenant issues, just pure passive income.
That paints a pretty clear picture, a stark contrast to, say, managing a volatile stock portfolio or buying another rental property.
Absolutely. And then you connect it to concepts they already know and trust. That's key for familiarity.
Like what?
You compare it to things like an annuity, or maybe even frame it as a second pension. Something reliable, steady. The moment it clicks, the moment it feels like something their parents might have relied on, or a structure they already understand from their own retirement planning.
Like a fixed, predictable income stream.
Exactly. That feeling of familiarity makes it feel safe. And a lot of the resistance just melts away because you've replaced the scary, unknown financial jargon with the comforting structure of a monthly paycheck they understand.
Makes sense. Now, what about the seller who really cares about the community they built? This isn't just an asset on a spreadsheet for many of them. This touches on legacy and control, right? And we still need to tackle that default risk head on.
Yes, for many longtime park owners, the community itself, the residents, are a huge source of pride. They worry about what happens next. A quick cash sale often means selling to a faceless corporation or an unknown entity. They might worry the new owner will jack up rents, neglect maintenance, or just not care.
So they lose control over the future of what they built.
Exactly. But seller carry gives them back that control. It allows the owner to essentially script the next chapter for their park.
How so? by choosing the buyer.
Precisely. They can handpick the next owner. They can choose a buyer whose values align with theirs, someone they believe will protect the residents and maintain the community culture they fostered. It's legacy in action. It's control that extends beyond the closing date.
So you sell to the buyer you want to see succeed, not just the one who showed up with the biggest bag of cash first.
That's the idea. It adds a whole layer of personal satisfaction and ethical consideration.
Okay, but let's face it, the default objection, it always comes back to this, doesn't it? Every seller's thinking, okay, this sounds good, but what if the buyer I carefully picked stops paying?
Hmm.
That's the fear that can kill the deal.
It absolutely is. And you have to validate that fear. It's a perfectly reasonable question from a prudent person. But then you have to fundamentally flip their understanding of the safety mechanism involved.
Flip it how?
By explaining, counterintuitively, that default can actually turn into a second payday.
A second payday. That sounds too good to be true. How does a disaster like default become profitable?
Because the seller isn't just relying on the buyer's promise. They hold the mortgage note. And crucially, the park itself is the collateral.
Right. They have security.
Massive security.
Yep.
You remind them, if the buyer defaults, which, by the way, you structure the deal to make less likely with a significant down payment, but if they do default, what happens? The seller keeps all the monthly payments they'd received up to that point. They keep the entire, usually substantial down payment, and they get the entire park back.
And they get it back potentially after the buyer has made improvements and certainly after the seller has collected years of payments and a down payment.
Exactly. Let's say the park was worth $3 million. They collected a $500,000 down payment plus monthly payments for, say, 5 years. If the buyer defaults then, the seller gets the park back potentially now worth more than $3 million, and they've already pocketed maybe $500,000 or more in cash.
Yeah.
They essentially get paid, and then they get the asset back too.
When you put it like that, the note holder actually seems safer than, say, a stock investor who just hopes the market doesn't crash.
Far safer in many ways. You normalize this. You point out banks build their entire business model around this exact principle every single day. It's how secured lending works.
Wow. That transforms default from this terrifying catastrophe into a built-in, potentially profitable safety net, secured by an asset they already know and trust. That is a really stunning reframe.
It addresses the core fear directly and replaces it with a sense of security.
Okay, let's wrap this up. What's the final nudge? The outline mentions ethical FOMO. What's that about?
FOMO as in fear of missing out, but used gently, ethically. It's a polite tease of future regret, not high-pressure tactics. You appeal directly to their established self-image.
As prudent, responsible people.
Exactly. You're not trying to change who they are. You're asking them to be consistent with the financial wisdom they've shown throughout their lives.
So the nudge sounds something like,
Look, you've always been careful with money, always focused on long-term security and smart returns. Wouldn't it feel a bit odd to walk away from a higher, safer yield now, especially when taking the cash means taking a huge, immediate tax hit?
you're aligning the seller carry option with their own identity as a wise steward of their assets. You're not pushing them into something new and risky. You're inviting them to make the same kind of smart, predictable choice they probably would have made 20 years ago.
Precisely. It's about consistency with their own values.
And the final practical objection, liquidity. What if I need a chunk of that money down the road? Cash is instant. A note takes time.
Right. And you address that by reminding them the note isn't money locked away in a vault forever. It's an asset, a valuable, often quite liquid asset.
Meaning it can be sold.
It can absolutely be sold to a note buyer if they need cash later, or it could be refinanced. Or you can even structure the note with a balloon payment a certain number of years out, allowing them to get a large lump sum of the principal back at a predetermined time.
So there are options for accessing capital if needed.
Many options. The key takeaway for them is simple. You are done with the headaches of being a landlord, done with tenants and toilets. But by using seller carry, you are not done earning significant income from the asset you spent decades building.
Okay, let's bring this full circle. It feels like we've really mapped out how strategic communication, grounded in psychology, can completely shift the landscape for a seller.
Yeah, it moves them from seeing cash as the only safe harbor to recognizing it can actually bring volatility and tax burdens.
And it leverages their identity, their pride in their work, their desire for legacy, making seller carry feel like the smarter, more dignified path, not just the one with the highest immediate price tag.
Exactly. The real goal isn't just winning the negotiation on price. It's achieving long-term financial alignment for the seller, getting them that steady, lower taxed income stream they need and deserve in retirement.
It's about asking them to choose foresight over fear, really. Sophistication over the potentially misleading simplicity.
Well said. We humans, we often default to the simplest path, don't we? We assume it's the safest.
But maybe real wisdom, especially when dealing with these major life assets, lies in choosing the move that ensures your wealth keeps working for you long after you've stopped working yourself.
Absolutely. The mark of a true financial pro, or even just a savvy owner, isn't necessarily how fast they can sell their asset. It's how strategically they structure the exit so their money keeps earning and their tax bill stays manageable for years to come,
This is the deep dive.
where the buyer's playbook gets flipped upside down.